Thanks for the introduction, Ian. I really appreciate it. And thank you all for taking the time to listen to me today. I know everybody's time is valuable, and I appreciate you sharing it with me today. So I'd like to give you a little bit more background on myself. I started my career 20 years ago, as Ian mentioned. I was on the sales side at UBS here in Sydney. I was covering consumer good companies such as Burns Philp, Goodman Fielder, Coke, and Foster's. I actually remember my very first stock under sole coverage when I first started was British American Tobacco, so it really shows my age there. You know, given my stocks had overseas operations, they had overseas competitors, I always watched and analyzed the global companies just to benchmark my views on my domestic stocks. I started investing directly in global stocks in 2006, and you know, over the past 12 plus years, I've become increasingly convinced there's a vast opportunity set out there that the typical Australian investor is just not participating in. As Ian mentioned, I've been with Ellerston for almost 3 years now. Before that, I spent 6 years managing money for a family office based in Melbourne. And with that family office background, I am just as focused on capital preservation as I am on capital growth. So it's really great to be here with you today. As the title mentioned, it's global smalls, they're too big to ignore. And I want to just kind of highlight a few things in terms of why they should be part of any domestic investment portfolio. You know, the global market's vast. You have developed markets, you have emerging markets, large cap, mid cap, small caps. And you know, it can be very daunting if you've never invested outside of Australia before. The natural starting point for many domestic portfolios is investments in just the Australian large, mid, and small caps. And I want to talk about why a diverse portfolio, including the global mid-smalls, actually helps improve the growth profile of your portfolio, and associated with that actually lowers the investment risk of your portfolio. Then we're going to spend a few minutes and talk about a really exciting long-term thematic that we're looking at right now. And we'll talk about a couple very interesting mid-small cap companies that have long runways of growth ahead of them and catalysts for continued share price performance. So this is a disclaimer. Everybody's seen these before. I'm sure you'll see more today. Mine basically says, take everything I say with a grain of salt, okay? So I think it's important we put what we call global mid-small caps into context and understand what I mean when I talk about that investment space that we participate in. You know, there may be a real misperception that when I'm talking about global mid-smalls, I'm talking about very small market cap companies, which would carry a high degree of investment risk. You know what? It's actually quite the opposite of that. When we talk global mid-small caps, we're focused on companies which have market caps of around US 10 billion and below. And I've highlighted a few here for you. You have Zayo Group. They're around 8.5 billion US market cap. Teradyne's around 7 billion. Huntsman, just under 7 billion. When you look at some of the comparable companies here in Australia, we're talking about Australian success stories such as Cochlear, the Australian Stock Exchange, and Treasury Wine Estates. You know, these companies would be considered large and safe in many domestic portfolios. They all have market caps at or below US $10 billion. They would be considered mid-small caps in our investment universe. And to put it in context, if Zayo was listed here in Australia, it'd be a top 40 stock. It'd be bigger than the AMP, bigger than Computershare, and bigger than Stockland Group. So I just want to put all that into context for you when we talk global mid-smalls. Now, looking at the performance of the US, or the MSCI mid-small cap index over the last decade or so, you can really see the performance there. They're the top line there. I know it's a crowded chart, and I apologize for that, but that's the top line is the US mid-small cap index. And on this chart also is included the MSCI World Index, and really the main difference is the World Index includes the Amazons, Google, Facebook, a lot of the mega cap companies that are out there. Also on this chart is the Australian Small Ordinaries Index and the Australian ASX 200. So as you can see, since the beginning of the decade, the MSCI Mid-Small Cap Index has outperformed both its large cap and small cap peers. And I think it's important to remember this period of outperformance includes, you know, the tech bubble in the early 2000s and the GFC in 2008, 2009. So I know it's great to say an index outperformed, but you know, as I mentioned earlier, I was with a family office, and I'm just as focused on risk as I am on returns. And this is an interesting chart which shows rolling volatility. So what it is basically showing that the global mid-small cap index has around 260 basis points less volatility than the Australian Small Orient Index. It's quite powerful over time when you think about capital preservation. To avoid those capital drawdowns is very powerful over time. So now that we've talked about the global mid-small cap size and put that into context, we talked about the relative performance. We've talked about how they can generate this attractive returns with relatively lower risk. What about the diversification benefits for your portfolio? Australia has some very solid companies. And one thing that's quite clear to me, though, in an increasingly globalized world, some of the best investing opportunities on the planet and some of the strongest investing trends globally are just not accessible here in the Australian market. So this is a chart showing the universe, and it's big. I'll tell you, it takes a lot to get through this. And if you focus on the left-hand side of the chart there, that's the mega caps. Anything we describe as US 10 billion and above. Just over 1,100 stocks in that index, and the race was on to be the first trillion-dollar stock. That was eventually won by Apple over Google and Amazon, although Amazon had breached that level as well. You think of a $1 trillion stock. And when you think of that $1 trillion, that's why, as Ian introduced me in the beginning, why a US $10 billion stock is a mid-small cap overseas. Now, the thing with these big mega cap companies, they're very well researched. These companies have become a lot easier to invest in. There's some great funds out there that gives you the exposure. You can buy some ETFs to get exposure, or you can invest in them directly themselves. Pretty much every brokerage house on the planet has at least one analyst covering those stocks. There may be up to 40 different analysts covering a stock like a Google. I noticed late last week another analyst initiated on Google. I'm thinking, Alphabet, they changed their name. I'm thinking, what's the 39th analyst going to say more than what the previous 38th analysts say? I'm sure it's very good stuff, but I'm just wondering, it's hard to get that edge given that that end of the market is so researched and covered. Now, if we move to the right-hand chart of the right-hand side of the chart, we can see the global mid-small cap universe. It's just over 8,000 stocks. It's 7 times larger than the mega cap universe. And you know what? It's a lot less research. There might be 1 or 2 analysts actually covering some of these stocks. We have one company that only 1 analyst covers it. And I believe this setup creates a great opportunity for those willing to do the work. If we cast our minds back, you think of those Australian success stories such as the ASX, Cochlear, Treasury Wine Estates. They've been some of the best performers in the domestic market and have some of the best compound growth drivers for domestic shareholders. So they're well-run companies. They're sub 10 billion US market cap. They're mid-small caps in my universe. So the way I'm trying to phrase this is, why should any portfolio not have this exposure globally as well? Although one thing I will point out, it's a lot harder to get this exposure to these global mid-small caps than it is to get exposure to the global large caps. Like I mentioned, a lot less researched, and there's a lot of them to go through. And I'll talk through a little bit of some of the opportunities we're seeing there later on. Now, this is an amazing chart. This is basically talking about the replacement cycle in the S&P 500. What it's telling you is that roughly half the S&P gets replaced every 20 years. They have to be replaced by, it's called the S&P 500, so if you're going to have companies move out of them, and it may be because they've been taken over, it may be because they've been disrupted. You think of a lot of the retailers that have left that index. Different reasons why they may leave the S&P. It has to get replaced by new companies. And those companies are typically the mid-small cap companies of today. Now, with that replacement cycle, you think of what's happening globally with technology. Technology is accelerating. And what could happen with this replacement cycle, it could actually condense even further from here. So you could see that replacement cycle go from, it's on average around 20 years now, the average life cycle of an S&P company. It may come down to a decade over time. So with that setup, you think of what's happening globally with the replacement cycle, you think what's happening with those mid-small caps. If you're not investing in those global mid-small caps today, you're potentially missing out on those large caps of tomorrow. And to put that into a little more context, you look at Amazon and Netflix, they both started their lives in the mid-small cap space. Amazon listed in 1997 with a market cap just over 400 million US. Now it's close to $1 trillion. Netflix was the mid-small cap up until 2013, and now it's $160 billion. So don't feel sorry for a little Netflix there. It looks a bit odd in that chart. That's $160 billion market cap. Just shows you the scale of what Amazon's done over time. So just to summarize a little bit in terms of what we discussed so far, you think of the context of the size of the global mid-small cap universe. They're big companies and similar sizes to the success stories based here in Australia. Typically the Australian investor will have quite a massive home bias in their superannuation and personal investments, mainly skewed to investments in Australian stocks. In recent years, I do believe there's been a significant opportunity cost as, this chase for yield has not given the benefit of access to diversity and growth offshore. So I hope I've provided some interesting information around what they are. The key takeaways for me is, they're not that different in size to many success stories based here in Australia. They provide stronger returns with attractive risk profiles. They help future-proof your portfolio and at the same time help provide diversity. The global equities, they do operate in much larger addressable markets. And that, over time, that translates into better projected performance and downside protection for your portfolios. Okay, so now we're going to have a little bit of fun here. So this is a big theme that's going to, I hope I'm back here every year for the next decade because we'll be talking about this theme for several years to come. And what it is, I think we're on the cusp of a revolutionary shift in technology which will have pervasive effects across many industries. And to put it in a little bit of context here, I'm sorry that this is a bit crowded chart as well, but what I want to show you here is every decade or so a new computing cycle emerges. And the thing is, each iteration of that cycle is typically 10 times larger than the previous one. And because that cost to compute is entrenched in those different cycles, the cost of addressing each cycle comes down as well. So if you look at the PC cycle, that was hundreds of millions of units. That's going to the desktop from the mainframe effectively. Then you move to the mobile internet, your smartphone. That was billions of units. We're near the cusp. It's still growing, but near the end of that cycle in terms of the smartphone growth. The next cycle is going to be driven by data. And it'll be driven by tens of billions of units. We're at the start of a new cycle, and it's going to be centered on data. You've probably heard a lot of people talk about the artificial intelligence, machine learning, you name it. There's a lot of these buzzwords out there, and it's really hard to understand what it means today, but you'll hear more of that. I'll guarantee you it's just going to continue to accelerate in terms of that awareness and what these can offer to the industries. The difference now, though, with this compute cycle, the first one was basically, your PCs. Second one was your smartphones. So very specific in terms of the end device. This next cycle, we're having a number of different technologies emerging at the same time. So we talked about artificial intelligence, but you take a step back into the industrial Internet of Things and the Internet of Things in general. That's going to be billions of units being connected over time. Artificial intelligence and machine learning helps all that data come in to be analyzed and to understand what it means. That's what it's all about. And then you're going to have virtual reality, augmented reality coming through, and that will be able to look at this data in real time in a virtual form, which is going to be pretty exciting. And all this comes down to automation. You're going to have a lot of talk about collaborative robots come through. You're going to have a lot of applications come through which helps industries and even us ourselves as consumers do things better, faster, and cheaper than ever before. Now, the thing with the compute cycle, and we talked about artificial intelligence, virtual reality, industrial Internet of Things, none of it will actually work without 5G coming in. So there's different iterations today. Like, let's face it, artificial intelligence has been around for a while, but now it's going to be deployed at scale. And what you need is a network that can handle those billions of devices all being connected at the same time. So the trouble is right now, it's really hard to pick a winner in this space. All this is happening at a pace, and the disruption's happening faster. The technology curve is getting shorter and shorter, so it's very hard to pick the winner in what's happening. But I'll guarantee you, every company on this planet is developing a digital strategy. It's not a question of if they can or could be disrupted. It's a question of how. And it's a question of how can we be ahead of this curve. And every company that we talk to, every company that you'll talk to or hear from are taking this very seriously. And it's not, it used to be at the chief information officer level. Now it's at the CEO level now. All CEOs are worried about that next Silicon Valley startup which could clip at their heels. Now, as I mentioned, it's very hard to pick the winner. So we actually like investing in companies that are providing the digital picks and shovels in this space that are underpinning this generational shift. So right now we're at the very early stages of this 5G rollout. We're seeing a lot of telcos globally, launching beta markets. We've seen Telstra domestically. They're talking about a 5G market up on the Gold Coast. And it's going to require a lot of time, a lot of spend, and a lot of testing. There's going to be a lot of testing of these networks, a lot of testing of these devices that go on this network, because it needs to, security. Security is going to be massive, and you have to make sure these networks and devices all work together and don't have all these security breaches that could potentially come through. One thing I'll guarantee you with this 5G rollout, I can't guarantee you, but my gut feel is that it's going to take longer than expected. This is very hard. This is a whole new technology to come through, and that's why there's all these big telcos spending a lot of money trying to determine where they're going to be placed in this new technology trend. 5G is going to be a land grab, but you know what? No matter who wins in this land grab, one thing you do know is that data growth, data generation is going to accelerate from here. Now, this is an interesting chart. I actually was at a conference, and this was shortly after the GFC. It was around 2012, 2013. And this was put up by a UK data center owner. And what really stuck out at me was he said, show me where the GFC was on this chart. This chart is a chart of data growth, effectively. And you know what? You can't see it. The chart goes up to the right. And whilst the stock prices during the GFC would have fluctuated around, you knew that their underlying drivers were rock solid. Economies, we all know what happened through the GFC in terms of economic growth. Can't see that in this chart. It's just going up to the right. But more powerfully, when we look at the next chart, see, this is 2012 here, and this is what's expected to happen when all these new applications come in, when 5G gets rolled out globally, when you have all these new use cases being developed. And let's face it, there's going to be use cases that we haven't even imagined yet that are going to come out, and that's the really exciting part about all this. So with that as a backdrop, let's have a look at a couple mid-small cap companies that we're really excited about. So this is Zayo Group. When we think of that demand for data and the movement of data traffic, this is going to continue to expand dramatically over the next several years. With the introduction of digital streaming, cloud computing, the new applications associated with 5G and AI, we're going to see mobile traffic grow at a compound rate of over 30% over the next several years. And Cisco estimates that network connection speeds will triple by 2021. You think of what we've just seen in the past few years with AWS, Microsoft, Spotify. All those have been driven by 4G. All those have driven significant bandwidth growth, and that's without 5G coming in yet. Just think where that chart can go over time. Now, to put it into context, fiber is to data what the road is to cars. Without fiber, data can't move. It can't go through data centers. It can't go from the cell towers to those data centers. You need that fiber to create that road for the data. The way I try to think about it, fiber is the essential infrastructure for this next wave of innovation we're going to see over the next decade. However, the interesting point about all this is fiber is actually becoming increasingly scarce. There's been a lot of consolidation globally, and especially in the US, as cell tower companies, as strategic companies, as private equity are buying this fiber to lock it away. It's incredibly hard and costly to lay fiber in cities like New York and Boston and Chicago. Companies with the incumbent infrastructure in there just gets more valuable as consolidation increases and they become scarcer assets over time. It's interesting to note some of those deals were done at mid to high teens EBITDA. We're hearing deals done at 20 times today. It's incredible the demand that we're seeing from investment companies and strategics to lock down this strategic asset. So Zayo is an infrastructure owner. They own their assets. They own the infrastructure. the fiber. It's almost 130,000 miles of fiber, which translates into 12 million fiber miles. They are one of the deepest, densest owners of fiber in the US. They also have assets in Canada, the UK, and Europe as well. So as an infrastructure owner of these fiber assets, they play a critical role in the movement of data. And the thing is, when you look at that previous chart of what's happening with data growth, you can just imagine the demand for that asset over time. It's a fixed asset, very hard to replicate. So it's a very powerful thematic underpinning the business. See how it trades at 10 times. It's on a 10% plus free cash flow yield, discretionary free cash flow yield. Transactions done at twice that level today. Given you've got the backdrop of a very strong thematic, you got the valuation where it is today, it's a really good setup for this business. So another company I'd like to touch on a little bit is a company called Interaction. I'm sure a lot of people have heard of NextDC here in Australia. The way I like to describe Interaction is basically the NextDC of Europe. It owns 50 data centers across 11 countries, and they actually touch, now it's over 75% of European GDP in terms of where their data centers are placed. It benefits, again, from that data growth over time. One of the more powerful attributes of this business is that 70 to 80% of their incremental growth comes from existing customers just growing inside their data centers. So you think of the Microsofts, the Amazons, all these companies that are developing digital strategies are growing very strongly inside that facility. It's expanding its capacity by 30% over the next 18 months. Sounds like a lot, but you know what? A lot of that capacity has already been pre-sold to those 70 to 80% existing customers. They need to lock down that space to address their future growth of their existing businesses. 95% of their revenue is recurring every year. Every January 1, they open the doors, they know 95% of the revenue is there. And that 5% is basically the churn that comes out of the business, and that can just come from businesses that have been bought, businesses that you have natural attrition with businesses. Once you're inside these data centers, it's an incredibly dense ecosystem that you're operating in, mission-critical infrastructure, and typically you don't leave. The interesting aspect of Interaction today, it's growing top line in the mid-teens, and it's actually accelerated. When I look at the business, we've owned it for a long time. When I look at the business over the past year or so, it's accelerating its growth, and that's despite the business being twice as big as it was 4 years ago. Twice as big of a footprint, and it's actually accelerating its growth here. We recently had a call with the company, and it's interesting. What they're saying, we're seeing a step function change in demand. It used to be, 1 or 2 or 3 cloud providers, AWS, Microsoft, and Google, deploying in their data centers in a few of their regions. Now they're seeing 6 to 10 cloud providers across their entire footprint. The problem's not the demand, it's a problem of getting enough capacity. The beauty with this business is that they have enough land and power that can double the business over the next several years. So they can address this growth. It just provides an incredibly powerful backdrop for the business. So another way I like to think about Interaction, it's building digital factories, and it's going to power the internet, power any new technology cycle. And so when you put Zayo, and you think of Zayo and Interaction together, these businesses, they're both pure plays. They're both strategic assets. They're both, the scarcity value of these assets are going up. And no matter who wins in this land grab, no matter who wins in all the spend that's going to go into 5G and all the networks and all the new applications that are coming through, they will win. They'll participate no matter who the winner is there. So this is just a table on Ellerston's top 10 holdings today. And this is what we have exposure to. And this is what excites me about this business and what we have today. Some of the strongest investing themes, some of the big mega trends out there globally are reflected in a lot of the positions here today. You have explosive growth in compliance and digitization. So Equinity, computer share and link services here. Equinity is the #1 share registrar provider in the UK. They have 50% market share. They have 100% retention rate of their clients, and they're actually gaining new clients from competitors in the UK. They have over 70% of all new IPOs come to their platform. Aston Martin recently IPO'd, they're with Equinity. So that's a great business, good long-term growth, but the exciting aspect of the group longer term, they recently bought Wells Fargo's share registry business in the US. So it was the number 3 player in the US. And what they're going to do, they're going to transfer their technology into that Wells Fargo platform. Now, I'm going to give you a couple numbers here. Firstly, they have 26 different products they can sell to the existing customer base. So you think of a Lloyd's, let's say. So they will sell to them 15 different products. It could be, risk management. It could be know your customer. They have all these different products they can sell on top of share registry, employee share plans. There's a number of them. So their average today is around 10 per client in the UK. Right now, Wells Fargo has 1. So the idea over time is that they're going to be able to cross-sell into that Wells Fargo client base. And Wells Fargo's client base are demanding, they want it. They want to be digitized. They want to have all these new products to come in. So it's a very exciting long-term opportunity in that sense. So we touched on Zayo and Interaction. I just want to touch on Entertainment One for a second. We love Peppa Pig. So they own Peppa Pig. They own PJ Masks. They're one of the largest independent owners and producers of content in the world. You think what's happening with Netflix, Hulu, a lot of players are going over the top. Disney's trying to build their own over the top. They're all clamoring for high quality content. Entertainment One, like I said, is the largest independent owner of this content. They have a TV division. I don't know whether you've watched Netflix, but Designated Survivor. Netflix has just commissioned them to take that to season 3. Netflix is commissioning more and more programs directly with Entertainment One because they need that content on their platform. The family division is the real strong growth area of the business. So we talked about Peppa Pig. They're just expanding into China dramatically this year. Guess what? Next year, China is the year of the pig. It's a perfect opportunity for Peppa over there. $1.5 billion of retail sales with Peppa Pig. Next property is PJ Masks. It's just starting now. It's a JV with Disney. It's being broadcast across all Disney's footprint globally, and now starting to be monetized, starting to go into China as well. PJ Masks has gone from 300 to 500 million retail sales. They believe it'll be another Peppa Pig. Now we've got Ricky Zoom coming up. It'll be launched next year. It's all about merchandising. It's all about providing family-oriented content and selling the merchandise on the back of that. They have 7 or 8 more properties behind all this. When you think about its market cap, it's around 1.5 billion pounds. Netflix alone will spend $8 billion on kids' content this year. The demand profile is accelerating. The scarcity value is increasing for Entertainment One. Cellnex is the largest owner of towers, largest independent owner of towers in Europe. They have almost 30% market share of the towers. So you have a lot of companies like a Vodafone and Bouygues Telecom that own their own towers. What's happening over there? You have an outsourcing trend. Cellnex is there buying these towers and managing them long term. They put 20-year agreements in place on the back of these towers. They have 16 billion of revenue contracted in place, which is 20 years of revenue already locked away for this business. Premier, I've talked earlier about companies solving big problems out there. Premier is the largest group purchasing organization in the US. And what that is, so they have relationships with over 4,000 hospitals and healthcare systems. So they say we've got this, and a lot of them are member hospitals. They're long-term agreements with these hospitals. Like we're talking 15-year deals in terms of the buying arrangements with the hospitals. So they take this buying power and go to the suppliers and say, you know what are you going to cut us a deal for this cohort? And that's what they do. They combine and aggregate buying, and they save a lot of money for the healthcare system. That's the problem they're solving, is you have 1.1 trillion of healthcare service costs growing mid-single digit. All these healthcare companies and hospitals need to take costs out of their systems and do it quickly. The other benefit of Premier is that it has 45% of the US population's data in their network. So now we talk about artificial intelligence, we talk about machine learning. They'll take that data, make it smart, and sell it to the hospitals in terms of new products and platforms to show them how they can take more costs out of their system. Yep, sorry. I tend to ramble on a little bit. Yeah, so I'll just wrap up. And this is the performance chart of Ellerston Global Investments. EGI, as Ian mentions, the code. You know, I'm proud of the performance, but what I'm more proud of is the volatility around that performance. Our volatility has been 200 basis points less than the market, and what's not on this graph is upside, downside capture. Upside capture is over 80% in terms of market movements, downside's less than 30. Goes back to, you know, the family office background, capital preservation, and focusing on that growth. So I hope I've covered what global mid-small caps are in context, hope I've showed what the returns are, and I hope you're as excited about some of these opportunities as I am. So again, thank you so much for your time.